Hello everyone, welcome to a new video. Today I will be analyzing a company that I find very attractive at the current prices and that fundamentally has been doing very well over the past years. This company, as you could already see in the title, is Crocs, the classic shoe, or in this case clog maker, which I'm sure you already know about, and currently it is down about 60% from its all-time highs. Nevertheless, before I go into the analysis, let me quickly give you a short overview of the main topics in today's video. So first of all, I will start with a general introduction to the company very briefly, and we will look at some key metrics. Then we will go into the industry and competitors, followed as always by the financials, and the financials we will compare the ones of the company with two other competitors, which in this case I selected Nike and Deckers Outdoors. After this, we'll go into the stock price and the current valuation, which, as I already said, I find it very attractive. And finally, as always, I will be giving my personal opinion on the company and also my future plans with it. With that said though, and after I remind you that if you enjoyed the video, it would be super awesome if you could just give it a like, and please consider subscribing if you want to see also more stock analysis. But with that said, let's go for it. Crocs is a company that was founded in 2002 and sells casual footwear. Most of their shoes contain a material which is called Croslite, a proprietary one which is super comfortable, and I think that a few pictures will suffice to illustrate their product because I'm sure that you already know about it. Also, as a customer, I must say that not only their shoes and flip-flops and Crocs itself are super comfortable, but they are also of very good quality. From my personal experience, when I compare the products of Crocs that I have versus other brands that I have bought in the past, the ones of Crocs have lasted significantly longer. On their business model, they design the shoes, but then for the production, they outsource it to third-party providers. It's very common with companies operating in such business models. In 2021, 56% of the production was in Vietnam, and since the beginning of the pandemic, they have tried to diversify a lot more the production because before it was much higher what they were producing in Vietnam, and now they are also producing in China and also Indonesia, and as I said, they have diversified this a lot more. Then for distribution, they do so in more than 85 different countries through wholesale and also direct-to-consumer. In direct-to-consumer, they have both physical stores where they sell, of course, their products and also their e-commerce sites. Of company-owned stores, they had at the end of 2021, so in December, a total of 373 stores, up 22 stores from the same time in the prior year. And moreover, most of these stores were located in Asia-Pacific region, which also aligns with their growth plans as they see that region being the highest driver for growth moving forward. And later on, when we talk about the revenues, we will see how these different distribution methods are broken down. The next big topic to cover is the recent acquisition of Heydude, which just closed this past February 17th. Heydude, in case you are like me and had never heard of the brand before, is also a shoemaker that focuses on making very comfortable and also light shoes. So from a niche perspective, it is operating within more or less the same one as Crocs, so I feel like it is a very good addition, at least from a product side perspective. Then looking at the financials for this year 2022, it is expected to contribute around $620 to $670 million in revenues, and this is because the acquisition has just been completed now in February, but actually on a yearly basis they expect that it will report between $700 to $750 million. Many more details on the performance of the company, unfortunately we don't have them because, as I just said, they recently closed the acquisition, but I'm sure that we will hear more about this in the next months and quarters. And then for the financing of this acquisition, and this is also one of the reasons why the stock price has been dropping recently, they have paid $2.05 billion in cash and issued 2.8 million shares to Heydude's founder. And to pay this, they have entered into a $2 billion loan with an interest rate of approximately 4%. So summarizing, to pay for this acquisition, they have gotten into more debt, which, as we will see later on, it is slightly problematic because they were already at pretty high levels of debt, and on top of that they have diluted the current shareholders because they have decided to issue more shares. Moving to the footwear industry, this is expected to grow at a CAGR of 4% between 2021 and 2031. I couldn't find the exact numbers for the casual footwear industry, which is the niche in which Crocs really operates in, but for sure during the past 2 years it has been performing better than the overall footwear industry as people have stayed at home, and let's see how it performs in the future. But I would imagine that it will continue doing well because this trend of working from home is likely to be staying, maybe not at such levels, but still staying with us. On competitors, Crocs has a lot, which include companies like Nike, Adidas, Deckers Outdoor, Skechers, Stephen Madden, Wolverine Worldwide, BF Corporation, amongst many others. And one competitive advantage from Crocs is that it's a super recognizable brand. So actually, I don't know how it is in your country, maybe you can let me know in the comments below, but here in Spain, to describe a clog, which is the type of product that they sell, instead of saying clog or the equivalent of that in Spanish, whatever that the word for that is, we just say a croc. So really the name of the brand to describe a product. And this is something super powerful. Moving to the financials, first on revenues, the trajectory so far has been impressive, and especially this past year, 2021, the growth has been significantly higher than in the past. Breaking down these revenues by region, around 70% came from Americas, 15% from Asia Pacific, and another 15% from EMEA. The growth in 2021 was particularly high in Americas with 86% year-over-year growth, and on revenues by channel, it is almost 50-50% split between wholesale and direct-to-consumer. And looking at the digital sales from this, which is relevant as whenever these fall within direct-to-consumer, they generally leave higher margins. We see an overall decrease from 41% of sales in 2020 to 36% in 2021, clearly linked to the ease of the restrictions. And by region, the one with the highest digital sales as a percentage of total sales is EMEA, followed by Asia Pacific, and lastly Americas. Moving down the income statement, the company is profitable and has been increasing the profits every single year since 2018 at very high rates. Last year, the profits were of $725 million, and then looking at the balance sheet, this doesn't look very good as it has a debt ratio of 99.02% and a debt to equity ratio of 108, which both are very, very high. Essentially, they have the same value of assets as liabilities, and this is the picture of the company before the acquisition of Heydude, which now after the acquisition it is even worse. The good thing is that they are profitable and they generate significant cash flows, so if they wanted to pay this back, they could do so relatively easy. Actually, currently they owe $1.5 billion, and they reported net incomes last year of $725 million. So if they follow the same trend or even increase it, they could easily pay it back in around 2 years' time. Now that I mentioned this, let's talk about the impact of Heydude and what is the guidance that the company gave for this year 2022. On revenues, assuming the lower end of the guidance for this year, they will be reporting a year-over-year growth of 50.26%, and from this organic revenue growth just from the Crocs brand, it will be of around 20%, which is still very nice. And then in the bottom line, the operating margins are expected to decrease to 26% from 29.5% in which they had them in 2021. And on EPS, they are expected to have $9.7 per share, down from $11.39 this 2021, and this will result in profits of $645 million, which is down from 2021, but won't be that far away. And mostly this is due to inflationary pressures, the air freight has increased significantly, and the margins have been compressed. And also we must add that in 2021, they had quite favorable conditions because they got an income tax benefit and paid lower taxes than usual. If we now compare the financials of Crocs with the two competitors we mentioned, we see that the company is similar in size to Deckers Outdoors and much smaller than Nike, growing at faster rates than any of the other two. And on the bottom line, all three companies are profitable, but Crocs has net income margins higher than the other two. On valuation, I have already considered the shares outstanding after this acquisition with Heydude because, as I mentioned, they issued more shares, and currently it is trading at a PE ratio from 2021 earnings of 6.58 times and a forward PE ratio of 7.39 times, which is higher looking forward as the profit margins this year 2022 won't be as high as the last one as we commented previously. And comparing it with the two competitors, Deckers Outdoors is trading at a PE of 17.48 times and Nike at 29.32 times. On this, I must say that the two competitors, the fiscal year ends around middle of the year, so the profits correspond to a period a bit before those of Crocs, which really ends on the 31st of December. So the P ratios are likely to be a bit lower for the two competitors if, of course, their profits increase, which, considering how well the economy was doing, I would assume it's so. But still, we can clearly see that those two competitors are trading much more expensive than Crocs. With that said, and after everything that we have analyzed, what are my thoughts on Crocs? Well, as I already mentioned at the beginning, I think that the valuation currently is very attractive, and also from all of the metrics, fundamentally speaking, the company has been doing very well. The only red flag that I see is that they have quite a lot of debt, and they got into more debt now with the acquisition. But am I worried about this? Not really, because they are really a profit machine. They reported very high profits. They have quite high net income margins, as we saw in the previously when we were comparing it with the other competitors. They are also cash flow positive. So if they really wanted to pay down all the debt, they could easily do so in between 2 to 5 years time. And of course, if they just want to reduce it a bit, they can easily do it within the next few years. Of course, this means that they need to do it as well or better than they have been doing right now. So if we reach a level of great recession, or if there's really a nuclear war like some are speculating and so on, this can really harm the company. But as I said, in a normal environment, I think that this is very feasible to pay down from Crocs perspective. And also, if they wanted or they needed to raise more cash to pay down debt, they could easily just issue more shares. Of course, it wouldn't be nice for the shareholders, but that's something that they also have as a resource. With this in mind, and considering that the company has publicly said that it expects to report around $6 billion in revenue by 2026, of course that's their goal. Let's see if they are able to achieve that. But in that scenario, the company would essentially double in size from where it is at right now, basically double at least in revenues. And not only that, but also their current valuation multiple, as we saw, is extremely low comparing it to other competitors. And I think that one of the reasons for that is that they have, as we mentioned, a lot of debt in their balance sheet. So I feel like if they are able to reduce that and also continue performing well, maybe not as well as they have done in the past, but as it is planned, it is likely to more than double in the upcoming 4 years, which I think that it provides a rate of return pretty attractive. And of course, if it falls at even lower levels than it is now, even more. Anyways, please remember that everything I share in this video is just based on my opinion, my research, and my calculations, which of course all of these could be wrong. I take absolutely no responsibility, and you should always do your own due diligence whenever investing in this or any stock, as I am no financial advisor. With that said, what are your thoughts on Crocs? Do you think that it might be a good investment at the current prices? Please let me know in the comments below. If you enjoyed the video, then don't forget to give it a like, subscribe to the channel if you're not yet subscribed, and as always, see you next time.